In both the UK and the US, and likely across the world, data shows there's been a drastic increase in the amount we're keeping in our savings account, despite the non-existent interest rates and the looming inflation. Is this a good thing or a bad thing? And what do we need to consider? In this video, we'll discuss the pros and cons of savings accounts. We'll take a look at some data and analysis to understand why keeping your money in these accounts might actually be losing you money. Depending on your circumstances, you might be losing thousands. So make sure you watch through to the end to understand why. Hi, my name is Stephen. I'm a data insight manager. In simple terms, I manage a team of data analysts. I also have a strong background in finance. If you're new to the channel, welcome to the Investors Circle, a community devoted to personal finance and investing. My goal is to help you make every penny grow. No amount is too little to invest in your financial freedom. All I ask in return is that you please hit the like and subscribe button and also the notification bell so you don't miss any videos. So what's the format? First, we'll get into an overview of savings accounts and their history. Then we'll get into some data and analysis to understand how they might be losing us money. And lastly, I'll share how I have used these learnings personally. First of all, I'd like to say being able to save is not at all easy, and due to this it's very important that what we do manage to save is secure. According to the Office for National Statistics, 10% of the UK population have no savings at all, and 41% of the population have less than £1,000 in their savings. This highlights that liquidity is very important to the vast majority of the population, with their savings being required for short-term goals or as an emergency fund. Savings accounts offer excellent liquidity and security for your money, with the added benefit of some return, if you could call it that. Historically, the benefits from savings accounts were much greater. You could get an average of 8% on your savings annually, whereas now you'd be lucky to get 1%. If all your savings are reserved for short-term goals, the savings account might be perfect for you, because the impact of inflation and taking risks to grow your money are likely to be of low importance, as you might need that money tomorrow or next month or sometime soon. So access and liquidity are of high importance. If you have enough savings for your short-term goals and some more to spare which you can put away for your longer-term goals, liquidity and access are likely to be of lower importance, as it's likely money you do not want to touch for a few years. The impact of inflation becomes a consideration, as well as the potential returns from other investment. The average rate of inflation across the past 5 years has been 1.7%, whereas the average interest rate on savings account is 0.4% across the same period. Interest rates provided by banks do not beat inflation, meaning your purchasing power is greatly reduced. To illustrate this, let's look at an everyday example. Let's say we have savings of £1,000, which today should be able to buy us everyday items worth £1,000. If we keep our £1,000 in our savings account with the 0.4% average rate of interest provided, our savings future value, or the amount it will be worth in 5 years, is £1,020, whereas the cost of goods we were able to buy previously for £1,000 before now costs £1,087. Our purchasing power is reduced by 6.6%. We're literally losing money. Despite this fact, although the perception of returns from savings have changed, where most people know the interest they earn is non-existent, culturally we still believe it's a good place to keep our money for our long-term goals. More recently, there's been a drastic increase in the proportion of our money we're keeping in savings due to the significant reduction in the opportunities to spend. It is fair to assume a reasonable proportion of this increase will be savings towards short-term goals, but some will also be savings towards long-term goals. I know a few people who have relatively large savings for longer-term goals in their savings accounts, as they are unsure about investing. Is this because they're not aware they are losing money from savings, or are they just not aware of the alternatives? I believe it's a mixture of the two. I was in the same position a few years ago. After doing some research, the option of having my money losing me money versus taking some risk to grow my money was far too great. I would suggest reading the book Rich Dad Poor Dad, which discusses the principles of investing in a simplified way. So what are the alternatives, and can they really help us grow our money? There are various forms of investments, from stocks, property, cryptocurrency, and so on. For now, let's focus on stocks and shares. As mentioned earlier, the average annual inflation across the last 5 years has been 1.7% compared to the average annual savings interest of 0.4%. According to Goldman Sachs, the average stock market return is 9.2% annually, with the S&P 500 index fund generating an even higher return of 13.6%. It is very important to understand that with these higher returns, there are some elements of risk to consider, as they are not guaranteed, but over many decades these returns have been proven. If you're risk adverse, you have to understand the probability of getting rewards without taking some risks is very low. The savings account is a good example. There's very little risk, but also very low returns. You will not lose your money, but you will also not grow your money either. Whereas in the stock market, there is a higher risk, but also a high probability of increased returns. You're likely to grow your money, but there is a chance your money may lose some value. Investing in growth or speculative stocks can provide even greater returns, but with significantly higher risks, as you may lose most or all of the value of your money. I would not suggest going with this strategy unless you're an experienced investor with the appropriate understanding. Not only are yearly returns from the stock market higher, if you stay invested over a long period of time, it gets even better. Let's have a look at how. Let's assume we have £500 a month extra after keeping enough for our short-term goals and needs. With this, we aim to buy a property in 5 years. Assuming the deposit plus all the required fees total £30,000, our monthly savings towards the property would net £6,000 annually, meaning we would be able to achieve our long-term goal in 5 years. Now let's compare this to if we invested the £500 saving. Being conservative, let's assume we achieved a 9.2% average return from the stock market. In year 1, our £6,000 investment would give us a return of £552. In year 2, achieving the 9.2% return on our current balance of £6,552 and the additional £6,000 we saved this year would give us a return of £1,155. And this continues until in year 5, the total value is $39,368 from our invested saving of $30,000, meaning our profit is $9,368. We hit our £30,000 goal in year 4 with an end of year balance of £30,051, which means we're able to buy our property 1 year earlier. At the end of year 5, the value of our savings would have been £31,005 if we had chosen to keep our money in our savings account, which is £8,263 less than the total value from deciding to invest in the stock market. This is the lost opportunity from keeping our money in savings accounts. Even if you have the ambition but you're not willing to put in the time and effort to educating yourself to learn to grow your money, again, the savings account might be for you. Without a good understanding, not investing might provide you with the best returns, as it prevents you from making losses. There are tools where you can earn good returns passively, such as Stocks and Shares ISA, where your money can be managed for you, or you can get a financial advisor. But if you are willing to have savings set aside for your long-term goals with the ambition and the will to learn how to grow your money, there are many alternatives for you to do so. Personally, I've invested a large proportion of my long-term savings in the stock market, with a portfolio that has growth stocks, value stocks, and some investment in index funds. I will be sharing the stocks I have or will be investing in. If you don't want to miss the video, then don't forget to hit the like and subscribe button. It will really help the channel grow. Also, please share the video with friends and family to help them with their personal finance and investing journey. Thanks for watching, have a great day, and I'll see you in the next one.